All right, guys. So thank you everybody for making it to the Zoom and Learn Wednesday with Annie and Tommy. We do have a couple special guests today. We have Ollie and Kelly from OneTrust Home Loans, who are going to give us not only their perspective on the market update, but they're also going to give us some highlights on Freddie Mac's programs moving forward to lenders and different programs that are available out there that have slightly changed, et cetera. And I'm not going to waste a whole lot of time myself trying to get into anything. I'm just going to hand it off to you guys, and let's go ahead and talk mortgage.
Definitely, let's go.
Awesome. Well, thanks for having us on, guys. I appreciate it.
So those, Kelly Kline is in the car traveling, but he was graceful enough to bless us with his presence and be able to speak with us today. So, guys, where do you see the market going? I mean, we're in the midst of COVID-19. We're in the midst of lockdown. We're in the midst of basically having everything pulled out from under us and us being told what we can and can't do. We have forbearances out there. We have changes in interest rates on a daily basis. We have different programs being shut down, new programs coming out. What are you seeing from the mortgage perspective?
You know, I think this is really an opportunity for the mortgage industry to really put a best foot forward and step up and find ways to support our country and our homeowners. You know, so many homeowners were just demolished back in the 2007, 2008, 2009 mortgage meltdown era. And the industry has gotten so much more intelligent and so much more focused on ability to repay debt. And I think we've been very, very lending appropriately for the last almost dozen years, 10 years just about since we came out of that meltdown era. And so, like you said, Tommy, there are a lot of things changing on a very regular basis. And some of them, the public has no idea what it really means. And realtors, for that matter, really don't know a lot of what it means. And so unless you're really diving into it head first because you're a lender or you really want to know, a lot of the stuff that's happening behind the scenes isn't necessarily great. You know, the whole forbearance stuff, banks are flat out just calling and offering consumers a forbearance plan, and consumers are going, oh, okay, well, I don't have to make my mortgage for 3 to 6 months. That sounds great. But what's not being told is what that looks like after 3 to 6 months, right? What does that repayment plan look like? What does the tax deficient escrow impound account look like? What is that homeowner's insurance policy that's due for renewal that your lender doesn't have any money in your escrow account do? Does your policy get renewed? Does it not get renewed because there's no money in the impound account? Like, those are all major question marks that the consumer should be wondering and inquiring about if they are not going to be making a mortgage for 3 or 6 months. And at the end of the day, the big challenge of it is that I do believe that interest rates are going to stay relatively low for at least a year, because that's what we can do as a country to preserve spending money. People need to be able to borrow cheap money and recirculate it back into the economy through consumer spending. And if we don't keep rates low, then all hell's going to break loose, right? Because you got people out of work for this amount of time. You got people paying, in a forbearance plan, and then all of a sudden they go back to work, and now they've got this mortgage payment that's $300, $500, $700, $1,200 more expensive than it used to be, and they're trying to play catch up, and they've got no money to do so because they've just been out of work for 90 days. So it's going to be interesting. But my my hypothesis here is I think we see interest rates stay relatively low for the duration of the year. Home purchases have obviously slowed down. The report that came out yesterday was pretty awful. I mean, the amount of homes on the market in the month of April was a really, really poor number.
Yeah.
And I don't believe that's going to change this month either. It may take until September before the housing market starts to pick up enough momentum to get back to a healthy amount of inventory on the marketplace. So it's going to be interesting couple of months, I think, ahead of us.
And I want to add something, not having a concrete plan with who's eligible for forbearance opened up the door that really didn't need the help with skipping mortgage payments. And that's created a lot more havoc because people are like, why wouldn't I skip 2 to 3 mortgage payments? But here's the caveat. You're going to have to pay. It's not like you're getting forgiveness. It's just a forbearance. So I think as people are getting educated, the clients we're dealing with, that's why on Mondays we're sharing client stories, because there's people that are in the middle of a refi that could have lost their opportunity to do a refinance because they were offered to do a forbearance.
Correct.
So I think the long-term ramifications we have not seen if things don't shift quickly.
So let's shift gears and talk Freddie Mac. So with Freddie Mac's role in providing different mortgage products to lenders and institutions out there, what's your view on that, and what's your view on the current market in regards to that moving forward?
So, interestingly enough, Freddie Mac and Fannie Mae don't mean a lot to the typical household homeowner. They mean a whole lot to the mortgage lending world.
Mm-hmm.
And so what we have seen as a nice relief and a nice change from both Freddie Mac and Fannie Mae, and fortunately, OneTrust Home Loan is a direct lender, and we do have a direct channel to be able to sell our loans directly to Freddie Mac and Fannie Mae, where not all lenders or brokers are capable of doing. So by making it a little bit easier to get an appraisal waiver, by adopting some more loose guidelines around obtaining customers' tax transcripts from the IRS, because the IRS is on, minimal employee, functionality right now. So some of the documents we usually need to get for a customer's tax returns, we're not getting. So Freddie Mac has decided to loosen up the guideline a little bit there. Getting, HR departments to verify employment with some companies is challenging because there's, minimized staff maybe, or staff working remotely. So their service processes for getting that information may not be as easy and fluid as it used to be. So the GSEs, that's what we call them, Fannie and Freddie, the GSEs, they're loosening up some of the parameters for us to be able to more fluidly deliver a loan to them for sale. And so, they're going to consistently keep trying to create a path of least resistance so that they can keep letting the banks lend more money. And so they're buying up these mortgage-backed securities, and the Federal Reserve is just taking them and bundling up as securities and having those being, available for the Fed to sell off in bond strategy. So it's all working. I mean, I think so far everything they're doing for the most part is creating more liquidity in the market. Liquidity is what's needed for banks to keep lending. And if they continue to make the moves that are necessary, they're going to also be working, because Freddie Mac and Fannie Mae apartment buildings and commercial buildings and stuff like that. So that sector of the marketplace is going to be significantly impacted because that's a good chunk of the renters of the world are, living in apartments. And those are the ones who are probably more likely the ones who are out of work right now. The hourly wage earners who, are waiters, waitresses, retail store clerks, things like that. Those are, your traditional apartment renters. And so you've got 50% of your apartment buildings with employees not making money. You're going to have a real tough time collecting your rents in those buildings. So Freddie Mac and Fannie Mae are doing a good job of trying to work with those apartment building owners and doing forbearance plans, doing debt restructuring on their building loans and things like that. So as far as I can see, in 20 years in the business, I think that those entities are definitely making some good moves.
We had a chat question that came in. It said from Antoine Robinson. He said, "Is it a good time for clients to refi?"
I would say yes, under most circumstances. Interest rates are still relatively low in the grand scheme of things. If you're in a position where you're trying to pull out cash, or if you're in a position where you're trying to refinance an investment property, those situations may be a little bit more tricky and maybe not as enticing or lucrative. But I would say this, for the high equity homeowner, meaning that you have a lot of equity in your house, and you have an interest rate over 4%, that right now could be a very, very enticing time to consider a refinance and the possibility of pulling a little bit of cash out because of the cost of funds.
Gotcha. Okay, so we can shift. Well, let's not shift gears yet and go back towards forbearance. Let's talk new programs that may be out there. Let's talk existing programs that were already out there, like down payment assistance, things like that. Let's talk that for the next couple minutes.
Yeah. So really, they're not loosening up too many new products right now. They're actually trying to tighten things up a little bit, and a lot of lenders are stopping and no longer offering certain products in the marketplace because they are still kind of worried about risk right now in the marketplace. So you're not really seeing as many of the down payment assistance products because, quite honestly, in my professional opinion, not everybody deserves to own a home. I think there's a barrier to entry for home ownership. And when people are essentially given a home with no skin in the game, they're much riskier and much more likely to default. So some of these down payment assistance programs are really only good for somebody who has a very particular circumstance, I think. And, they're really not built for everybody out there, and they're not built to be offered at every point in time in the economic cycle. And I think that where we are right now is not in a hugely appreciating position of the marketplace. We're going to see maybe a small pullback, maybe a flattening out of equity, but we're definitely not going to see a 3.5 to 5 to 7% equity appreciation run coming. And so you lend to somebody with 0.5% down and you fund all their closing costs, and you give them a loan with a sub 600 FICO score and you give them the money for the down payment. They got nothing to lose. I mean, no skin in the game there. So I think it's going to be a tough marketplace for that home buyer to get into the home ownership world here in the next 3 to 5 months.
And you also have to look at the risk factor of, when you do a DPA program, how quickly are they going to go into first payment forbearance? Why would a bank risk that? So, I mean, if you logically think about it, that's why a lot of lenders I was helping someone that was on this call find a lender that will actually do DPA right now. And even those lenders will tell you that they're working on steering them away from DPA programs and really having them put skin in the game. Because the reality is that's a better situation for first-time home buyers because they're not going to lose their home. I think being a responsible lender is really important. That's why we do our due diligence. And when we talk to our clients, is making sure, is this a good move for you? Is this a good time to buy? And you got to do the front end work.
Well, let's put facts out there is those programs are still available. It's just whether or not the institutions out there want to do them,
Yep.
so to speak. They are still available. All right, let's shift. I'm sorry? Okay, so let's shift back towards forbearance. I saw Andrew did pop on. Andrew, I know you've been, and I'm sorry to put you on the spot because I didn't know if you know whether or not I'm going to ask you anything, but I know Andrew likes to talk. So, Andrew, in regards to forbearance, I know we had a Zoom last week where you spoke a lot on this subject. You've done extensive research in regards to forbearance, the cause of forbearance, what may or may not happen, things that are being said in the marketplace, et cetera, et cetera. Give me a perspective on kind of the conversation that we had last week in regards to forbearance. I
think one of the biggest things, can you hear me okay, bud?
Yep.
One of the biggest things that we're going to see, similar to what I experienced in '94 and similar to what we all experienced in 2007, 8, 9, is there's going to be a disparity between what the GSEs say and what the lenders do. I mean, I was just on a call this morning with a lender, and as far as CalHAFA is concerned, they're fully operational. But this particular lender, because of their risk factors that they've set for their business, they don't want to fund those loans. And these learned gentlemen, spoke for the reasons why. But there are definitely two perspectives on this. One perspective is people don't deserve to buy. Another perspective is this is America and it's part of the American dream. So there'll always be two groups of people who argue that. But the issue is it's the lenders who are taking the risk. So there is a disparity. That's the chapter heading on this part between what Fannie, Freddie, FHFA are saying, what Dr. Calabria is saying, and what lenders are telling people in the public they can do or can't do. And that's going to roll over with the whole forbearance issue because the forbearance rules are not clear, but certain aspects of it are pretty clear. If you speak to your servicer, if it's a GSE backed loan, that you have a right without submitting any documentation to 6 months of forbearance. And that's a huge difference from the short sale storm that hit in 7, 8, 9 that the lender said I don't have the paperwork, and the short sale filer would say I've sent it. The lender would say I haven't. I've sent it. I haven't. I've sent it. And you'd lose 3, 4 months. And I went to hundreds of homes and knocked on the doors where people said, hey, I'm doing a short sale. And the lender had played around with the paperwork so much that they lost their home and they were willing to do a short sale. So this time, what came down from the government was, hey, there's no paperwork required for this. They wanted to circumvent that entire issue because, when there's a pandemic, you don't have money to feed your kids. You don't have 3 months for the lender to work out how to process the paperwork and claim their fax machine doesn't work. So everybody can file that, provided it's a GSE-backed loan, for 180 days. Then after, and I should say there, the important part of that is people have got to call their servicer. They can't just stop paying. And then the second part, they can extend for another 6 months, but you do have to ask for it. But there is a statutory right. This is a law passed in Congress that people can do this. Now, the next question that comes is, okay, what's going to happen to people who do file for forbearance. Obviously, they've got to get it in writing because the same issue is going to arise. Lenders will file inappropriately credit, which they're not lawfully allowed to do, but they will do it. And so you've got to have the written documentation. I think the HUD counseling agencies and the CFPB agencies are going to be extremely busy supporting consumers 12 months from now, where it looks like their credit's being trashed, but it shouldn't have been trashed. So there's complications in that arena that there is no simple answer. There's no nice piece of candy that makes this go away. The fact is, people are allowed to file forbearance for 6 months and another 6 months after. The lenders are not supposed to ding their credit or show that the payment is in arrears. Then the next issue is what happens at the end of the forbearance period. And there's a lot of word on the street. All you got to do is go onto Facebook and you see, Bob, the loan officer, saying this, and then Sally, the loan officer, saying that. What they're saying is just not accurate. It's a lot of fear mongering. So, the United States government has given a precedent of what should be done regarding the payment process. Fannie Mae and Freddie Mac issued joint statements last week. People will not be asked to pay in one lump sum. And an interesting term came up last week called a payment moderation, not a loan, payment modification, not a loan modification. And that's a category I'd not really heard much talked about before. The idea that you've got this arrearages and it has to be paid. And so, what are the choices? The end choice, if the borrower has not secured new employment, of course, could be a modification. But prior to that, you've got a payment modification, which is the idea of making a payment plus a supplemental payment. Plus is the idea of adding an amount onto the back of the loan. There's a number of issues. So those are really the three primary categories. And we're going to see a ton of legislation. We're going to see a ton of lawsuits. We're going to see, I predict that we're going to see scam artists setting up counseling agencies. Just pay me $3.99 or give me half your payment or all of this and I'll deal with it for you. And, I hope the district attorney puts all of them in prison because that's a mistreatment of the general public. So that's a quick overview of where I'm at on it.
Mm-hmm. Yeah, and I agree with you. 2007, 8, 9, we saw a lot of scams happening. And, back then it was, hey, we can keep you in your home type of scam, right?
Yeah, exactly.
And I think we're already starting to see some of those come out of the woodwork currently. And so something to definitely pay attention to. We did have a question that came up on the chat. It said, from Betsy Berkey at Realty Sky, it said, if you refi, can the lender ask you if you requested forbearance even though it's not reported?
Yes.
Yes.
Yeah.
Answer to that, guys?
We actually have a COVID-19 disclosure now in our loan documents that specifically asks you, have you been affected by COVID-19 financially, and is there any present hardship that you're currently experiencing as a result? And you have to sign that disclosure twice. You have to sign it at the beginning of your loan, and then you have to sign it at closing. And then that gives us, the lender, as much strength and support to protect ourselves that we wrote a loan for somebody who wasn't manipulating the system to take a loan knowing that they weren't going to be able to start making payments when that loan was ready to start making payments. So it is definitely a question that the lenders are allowed to ask.
Tommy, if I may interject there, what this gentleman is saying is absolutely correct. And that's the other category of people that are out there, is those who see this kind of system and, your word, sir, was manipulated. And unfortunately, those people are always going to be in America, that they will manipulate. That's one of my big concerns, is what happens when people get to 10 months and they've got their job back, right? But they like the idea of not paying that $2,500 a month, and they want to get that speedboat or the skis for the kids or whatever. And those are people who are going to manipulate the system. So unfortunately, they mess it up for the people who are genuinely hurting. I mean, as an immigrant to America, I've been there where I didn't have the money for food for my kids. And I've woken up in the middle of the night sweating bullets and worrying about my children. And in that instance, the forbearance is a wonderful blessing. But there are, as this gentleman says, there are those who will manipulate the system, and lenders have to protect themselves against those people.
You know, and I think that's why we've been so vocal, because we've been talking about forbearance from the onset of us being quarantined, because I think education is more important. As Andrew said, there's a lot of false information that's on social media, people not doing their homework. It's not about reading one article or watching one video feed. It's watching everything. It's, you know, Mark Calabria, you know, Andrew mentioned him. There are some things that he's not leveraging Fannie and Freddie Mac to the full extent of what they could do, because we even talked about new purchase business and what happens when a first-time home buyer buys a home and then all of a sudden goes into forbearance. Right now, based on what the GSEs are doing, it's the lender that's holding the bag and has to you know, eat the cost, which is going to hurt liquidity. And at the end of the day, if a lender doesn't have liquidity, they're not going to be able to process loans.
Yeah.
So Kelly and I were watching a video on this, and I think it's really, really important, as Andrew said, is well-informed lenders getting out there, educating the public that there are alternative options. Just forbearance isn't your only option. There's other ways that you can leverage your equity. If you are in serious financial hardship, there's plenty of lenders that want to help, because there's a lot more regulation today than there was in 2007, 2008. And I wasn't there, but Kelly was. And the requirements for a lender to get their license are very different today than it was before. So I think, as Andrew spoke, it's all about education, getting out there, you know, working with our clients to answer their questions, and then reaching out and making sure that they get facts and not manipulation tactics for them to do a refinance. In some cases, it might not make sense. So I think it's on a case-by-case basis, and that's what a responsible lender would do.
You know, I'm getting a lot of questions of agents asking me if we think there are going to be short sales. Are we going to have a big short sale boom again, do you guys think?
I'll let Kelly, because he's been in the industry for 20 years and he's been through 2008, 2014. So Kelly, why don't you take that one?
Yeah, my personal opinion is no. I don't believe so. I think that for the last 9 years in the industry, we've done a very good job of responsible lending. And we've also, for the last, 9+ years, seen very steady appreciation in the marketplace. And, we don't allow cash out refinances to be over 80% of a home's loan to value. So we're in a very equity rich point in time across the country that I don't think the short sale marketplace is going to be that of a very high risk one. And if you really think about the two components of the high risk of default homeowners, you've got the 3% down conventional, you've got the 3.5% down FHA, and then you have the no money down FHA. And so there's a lot of restrictions on getting into some of those loans, and so I don't think that those loans make up a very large percentage of the global picture of the current lending platform across the country.
I'm glad you said that, because that's kind of how I feel about it too. Andrew, your opinion on that?
Yeah, I mean, honestly, to be honest with you, I'm betwixt and between. Your 2007-8, well over 94% of loans bought by Fannie and Freddie were either NEGAM or IO. And as Kelly says, in the last, I'm not sure the number of years, 5 years, I think, less than 0.05% are NEGAM or IO. So that's a radical difference in the undergirding of the stability of the real estate economy. Having said that, what we're saying is, as logical people who've been in this 2 and 3 decades. So we've just seen panic sweep across America and turn upside down a 260-year-old constitution in 2 months. And that's what panic does. That's what propaganda has done. I grew up with communist propaganda. I get propaganda. So propaganda is extremely powerful. So if propagandists do have a dominant voice that causes fear, and people are afraid there's going to be a collapse, then they could irrationally decide not to start making payments again. If that happens in high enough quantity, those homes will turn negative. And if not because of lack of equity, just because of accrual of payments. And in that instance, that could escalate short sales. I think, honestly, that we're going to see a juxtaposition in the next 3 or 4 years. I think we're going to see people who say, life must go on. I love my wife. I love my husband. I want children. I want a house. I want good schools. I got a job. You know, I'm part of the 86, 87% employed. They're going to go on, right? And then there's going to be a juxtaposition of people who listen to, you know, America's falling down the tube talk, and they're going to stop making their payments. And I do think we'll see an increase in defaults. And we now have to see how the government will handle those defaults, whether they'll become foreclosures or whatever they'll do, or whether they will do whatever they can to stabilize that loan and prevent that home from being vacant. So it's a huge question mark right now.
I think Andrew touches on something, and when you watch, you know, the financial markets and the point of there's 2 points of view, and anyone that says they can predict the future, we've never dealt with anything like this. So I think the ramifications are yet to come, and that's why you got to keep, you know, reading and seeing what the GSEs do, because there are some measures that have been taken by the FHFA, and it'll be interesting. I just think they're putting lenders in a very precarious positions, and lenders assess risk. And right now, if the risk is too high, they're backing off those products. And that's what I think Tommy wanted to have this call about is, are, you know, the product's fully intact? And the answer is absolutely not. And I don't see that changing unless lenders are protected. And we have the GSEs to be able to do it and protect lenders. So that way, when they do quality loans, they have a safety net so they could keep their liquidity.
You know, something, I'm sorry, I didn't get your name, sir, at the beginning of the call. I got on late, and that's my bad.
Oh, it's Ollie.
Hey, Ollie. So this whole thing of liquidity, I love to hear you talking about this. And I do think a lot of people don't understand that, the liquidity place. And I don't need to repeat it because you said it very well. But here's like a negative thing that happens in a downturn is, if you get that, you know how we saw people marching through the streets and smashing bank windows and all that? You remember all those videos that you saw? Once that type of behavior escalates, it's this vicious circle that here we are, we live in a capitalist society. Capitalism needs government, it needs commerce, and it needs consumers. So it needs government, banks, and consumers. The minute you say the banks are the enemy, so this scandalization of the banks, the minute you say the banks are the enemy, what you're actually saying is, I'm not going to borrow, I'm going to rent. When you say that en masse, you are actually giving an enormous stimulus to capitalism. It's the exact reverse of what you think you're doing. Because if you have 3-4 million people say, screw this, I'm going to rent. Well, somebody has to own that rental. You've got 2 choices. I grew up in England when my dad ran cities of projects. That was his job. He worked for the government. So they were housing associations. So either the government owns it. I was in Warsaw the month after the wall came down. And you have blocks and blocks and blocks of government-owned projects. Let me guarantee you, everybody on this call would not want to live in one of those ugly gray buildings. There were blocks of cement. Or investors and hedge funds have to own the properties. We saw BlackRock and so on buying billions of dollars worth of property in the mid-2000s. So what happens is the minute you scandalize the banks, you think you're rebelling almost like a child against the capitalist system, but actually you're underscoring it, because then the capitalist organizations sweep in, buy more property than ever, and turn a new generation of people into renters who can't afford to buy. So the liquidity issue is really important. If the banks stay liquid, they're able to lend. And if they're able to lend and people aren't filled with fear, they will borrow even, sorry, Kelly, if they're zero down payment people, at least in their borrowing, they're supporting the system that we all believe in America, where we don't want the government to own all the housing. So I'm really hoping we don't see that sabotaging of the American mindset, and we'll lose another 10 years of our economic history.
Yeah, I think you said that very, very well. And look, you called me out on the zero down folks, which is totally rightful, because I do play that card, and unfortunately I don't focus too much of my energy on that consumer. But I feel like, I feel that clientele needs to be educated and find solutions and put in better positions than relying on some of the handout money and less ideal.
I think Kelly, see that?
Say again?
You froze right at the very, very end.
Yeah.
I just said, Andrew was very well said. I'm good.
All right. So I would like to open it up to anybody who may have some questions. We had a couple that came across, but we've answered them. Ron and Sherry and Star and Antoine, Betsy, you guys, if you guys have any questions, we're going to open it up for you. You can raise your hand, or you can just unmute it and pipe in. All right. If you don't want to, you can always put it in the chat. But I mean, outside of that, I mean, that was the purpose of this Zoom today, was really to discuss, where the mortgage economic stance is right now, right? What you guys are experiencing out in the trenches, forbearance, the actions around it, and what may happen. And I think you guys did a pretty good job of covering that for us. This video, we are recording it, so we'll definitely, post it out there. Is there anything that you or Kelly, Ollie, want to leave us with?
Well, I'll go first, and then Kelly will go second. But Tommy and Annie, thank you so much for doing this. I think it's great to create more and more virtual stuff that educates all of the industry and get this information out. And Andrew, thank you for not demonizing the banking industry, because the reality is a lot has changed, and we all need to work together, because all of us want homeowners to stay in their homes. And I think that's the end game for myself and Kelly. It's not about manipulation, it's about facts. And sometimes it's a good scenario to do a refi. Sometimes it's bad. Sometimes it's the right time to buy a home. Sometimes it's not. So I think it's on a case-by-case basis, and any responsible lender will approach their clients that way.
And we did have one comment that came in, or one question that came in, and it said, I guess this would be directed at Kelly and Ollie for the most part. How is financing going for any jumbo loans right now?
Kelly?
It's awful.
Terrible.
It's very, very awful right now. The jumbo world is the one that's struggling with risk the most at the moment right now. And because there's no backup group there, there's no support mechanism for the jumbo lender out there. If you lend jumbo money, you use jumbo money, and you got to be prepared to hold on to that money, which doesn't create more liquidity for you. It's parking, a large amount of money at maybe a discounted interest rate, and it's not anywhere. Money for a long, long time. And right now the banks aren't happy about it, and they're not interested in doing it. So the jumbo world is in shambles right now as far as that jumbo money. We're having
high balance loans aren't necessarily
boys going jumbo.
I think Kelly
Sorry, I missed the question.
Oh, no. I was saying the high balance loans aren't that much better either. So.
Yeah.
Correct. Yeah, I think everybody kind of suspected exactly that, but it's always nice to hear it direct, right? Kelly, anything you want to leave us with?
Yeah, I just want to say thank you guys for putting on a great Zoom meeting and bringing us on to talk about what we focus our energy and our lives on, which is education of the consumers regarding mortgaging. And just want to leave with the fact that before this whole COVID-19 pandemic started, home ownership was at all-time high. Home equity was at an all-time high, and unemployment was at a historical low. Interest rates were at historic lows. So when you start to couple those things together, you look at the global financial lay of the land. As soon as the pandemic is kind of released and everyone gets back to living, I think we're going to find ourselves in a fairly healthy recovery position as a country. And I don't think it's going to take us long to get our feet back under us for the most part. Certainly some businesses, may not be capable of opening back up, and there's going to be some casualties of war per se. But I think across the board, everything that I'm reading in speculation is that we come out of this thing and we get healthy pretty quick. And so I'm hoping for that, and I'm hoping that our education for our consumers helps them make good decisions, so they also come out of it pretty healthy pretty quick.
Thank you,
All
guys.
right, thank you.
Mm-hmm.
Andrew, you want to leave us with some final thoughts?
Listen, guy, I'm good. These two guys are sharp guys. I appreciate you having me on here. Thank you so much. We appreciate all that you do, Tommy and Annie. You guys have been loyal to us for well over a decade, and I appreciate you both immensely.
Well, we appreciate you guys. So,
Thank you.
all right, guys. Well, I appreciate it again. Annie and I will be doing a Zoom and Learn every Wednesday at 12:30, right here on the same Zoom link. And each week will be a different topic, and those topics are basically coming from the agents, the brokers, the lenders out there in regards to questions and things like that. So, we hope to see you all next week at 12:30 as well. Thanks again.
Yes,
Thanks,
please
Tom.
join us.
Kelly,
If you have any
Ollie,
ideas, let us
appreciate
know.
you guys coming on and dropping some knowledge with us.
Our pleasure. Thank
You
you
got
so
it.
much for having us, everyone. Be safe
Thanks,
out
guys.
there.
Thanks, guys.
Thank you.
Thank you.
Take care all.